Hello and welcome, everyone. I'm Tom Bowley, Chief Market Strategist at earningsbeats.com, and this is Trading Places Live. It's Tuesday, March 14th, 2023, and I'm pre-recording this Trading Places Live for just a little bit later this morning. Currently, futures looking pretty strong. We've got Dow futures up about 215 points, S&P 500 futures up about 32, NASDAQ futures up nearly 100. Crude oil prices down $1.10, back down below $74 a barrel. And the U.S. 10-year Treasury yield jumping today up 12 basis points back to 3.64%. It's been a very, very volatile time in both the stock market and the bond market. And I'll be talking about that in just a little bit. I do want to apologize. I have a little bit of a cold, and so I may have to take a break here from time to time. Somehow I picked it up on vacation, but it is nice to be back. I was out last week. A lot of things took place. I do think that some of the suggestions that I had left everyone with, that the market, certainly is vulnerable this time of the year. I think that has played out. We've seen the market really struggle. Of course, a lot of that more recently due to a lot of the banking issues. And we'll look at some of those banks a little bit later in the show, the ones that are being most impacted. There is an event this evening. I want to make sure everyone is aware. We do our regular monthly Max Pain events at Earnings Beats on the Tuesday before the Friday that options expire, monthly options expire. So monthly options for March expire this Friday. So today being Tuesday, we do have an event starting at 4:30 later today where I will go through and take a look at the overall indices, looking at the spider, looking at the QQQ to see whether or not market makers have financial incentive to take prices in one direction or the other. And then also look at some individual stocks that could be impacted this week. So if you'd like to join us for that, we do have a 30-day free trial. And if you're at earningsbeats.com, you'll find that no cost trial right here at the top of our page. If you'd just like to learn a little bit more about us at Earnings Beats, we do have a free Earnings Beats Digest newsletter. Name, email address, hit that subscribe button. That's all it takes. No credit card required. You can unsubscribe at any time. We'd love to have you. 3 times a week newsletter, Mondays, Wednesdays, Fridays. Try to get it out about an hour before the market opens so that you can digest it before heading into the market open. Anyhow, let's keep moving. Let me go through the agenda for today for everyone. Going to start off with the daily market recap, then we'll jump into talking technically. I'm going to look at the yield curve today, and I'll show you how you can do this on StockCharts. Very cool tool that they have. Take a little bit of a brief look at March seasonality. We send out a seasonality report to our members at the beginning of each month. I'll show you how that's kind of playing out at this point. Then earnings spotlight, we'll wrap up with the 3 you must see. So let's kick it off with the daily market recap. Yesterday, interesting day. We had a huge gap down at the open. I was really worried about the open yesterday. On Friday, I got back from vacation. I sent a quick message out to members saying that the volatility index had picked up. Looked like we could close at the highest level we had seen in the past few months. And as a result, you've got to be careful. A lot of times when that VIX gets going, you get these big gap downs. And we saw that yesterday. We saw a big gap down, but then the market rallied off of the initial lows. But it still was a fairly bearish day with a little bit of bifurcation. Dow Industrials finished down 90, S&P 500 down 6. NASDAQ, though, was up 50. So we had a little bit of a little leadership out of the NASDAQ, which was nice. Of course, we had a big drop in the 10-year Treasury yield, which I'll show you in a minute. And that, no doubt, probably helped some of the growth stocks on the NASDAQ. Mid caps down almost 2%. Small caps down 2.5%. So you can see mid caps, small caps clearly taking a big hit, much bigger than the rest of the market. Things have kind of turned sour in the mid caps and small caps area here over the past, just the past 3 or 4 trading days. Looking at the sectors, real estate and utilities, both doing very well. Of course, these are defensive groups that do tend to do well when the market struggles. So we saw a lot of rotation there, a little bit of rotation into safety yesterday. Financials down 4%. Of course, that had to do a lot with the banks and what was going on there. Energy down 2%. Don't know if you noticed it. That was a pretty big breakdown on energy, taking out that $82 support area, finishing below 81. Looks to me like energy could continue its fall. At this point, we not only lost that ascending triangle, which was a bullish pattern, but then we lost the sideways consolidation, the flag pattern that was in play. So this breakdown is noteworthy. Energy, historically, not a big fan of the month of March, and it is certainly started out that way again this March. Materials breaking down below the February low, still trying to hang on to the lows at the end of last year. The December low, I think we got down to about 76 and change, maybe around 77. We finished yesterday on the XLB at 77.38. So energy and materials will be very important to watch. Both these groups tend to do pretty well when inflation is kind of in the news. The fact that they're breaking down tells me that inflation is just another signal to me that inflation is not the problem that the Fed is trying to make it out to be at this point. Moving on to the 10-year Treasury yield, I do want to mention that the February CPI is due out this morning in probably about 30 minutes or so. The headline number and the core number both expected to come in at about a 0.4% rise. January was up 0.5% on the headline number and 0.4 on the core. And both are expected to be up 0.4% in February. So relatively flat with what we saw in January. That's the expectation. The Fed, which meets next Tuesday and delivers its policy statement next Wednesday, it's going to have a lot to think about as to whether or not they continue their rate hikes. Some were earlier suggesting maybe they'd raise 50 basis points next week. Now, with all the banking issues and the turmoil that's taken place, Goldman Sachs yesterday came out and said, we don't think they're going to raise at all. That was they're kind of out there on a limb by themselves. But I'll tell you, I'm right there with them. I don't think the Fed should raise, not after what we're going through or what we've gone through these past few days with the financials. I'm going to go through and show you yield curve and some of the things that can impact the markets in just a minute. But look at the XLF relative to the S&P 500 here just during the month of March. It has been a brutal 2 weeks for financials, and it's only been escalating here over the course of the last, 2 or 3 days. So financials not looking very good. Financials and industrials tend to perform similarly, but you can see this is a financials only kind of a deal. Industrials remain up near a 52-week relative high. So at this point, anyway, it seems like a lot of the weakness in the financials is being contained in the financials. And that's a good thing for the market as long as that continues. So let's move on. Let's move on to talking tech. Oh, I did want to just talk real quickly about the 10-year Treasury yield. So here was that big drop. 48 hours, we went from 4.03% down to 3.41%. Literally in 48 hours, 2 days. Huge drop in the Treasury yield. Now, we did hold on to the support that was established at the end of 2022 and early in 2023. That will be worth watching, but at least today, in the very near term, we are jumping. This chart doesn't show it, but we are up about 11, 12. Actually, let me give you the actual. Right now, actually, it's 9 basis points. We're back to about 3.61%. So 9.5 basis points below the 50-day moving average, which is at 3.70. That might be the first level to kind of watch, along with that yield gap resistance from the gap down yesterday. Anyhow, let's move on and look at the S&P 500. So in talking technically, don't really have a whole lot to say here. We did print a hollow candle yesterday, which was nice. We gapped down, as I mentioned earlier. We finished back above the gap down. I don't know if we've set the low here. It might be a little premature to make that call. I do think that there is downside still, especially if the market resumes its recent downtrend. I think that there is room down to gap support here at 37.50. The recent lows in here around 37.75. That range is what I would be watching to the downside. Personally, I'll be surprised if we lose that. I don't think we're going to, but anything can happen, especially when the volatility index is on the rise. The NDX, actually a really nice candle on the NASDAQ, finishing, did weaken into the close yesterday. It could have been a lot stronger. We had at one point a bullish engulfing candle. We finished with a piercing candle though, which is also bullish, just not quite as bullish as an engulfing candle. We did move back up and reclaim the 50-day moving average after moving just below it one day. With futures up today, this is going to be an interesting level to watch. Yesterday's open, 11,752. That is the area that I would personally be watching on the NASDAQ 100. If we go back down and close below that level, then I think the bears in the short term are back in charge. Until then, I think we're okay. Still maybe with a little bit of back and forth. We'll see. All right, moving on. I wanted to go through and talk about the yield curve. And I wanted to show you first, if you're just at your dashboard on StockCharts, go over to Charts and Tools. And then if you scroll down, you will see this dynamic yield curve tool. And if you hit this launch yield curve, essentially what happens here is over on the far left side, we have the short-term treasury yields. And on the far right side, we have the longer term. So we go from 3-month to 2-year to 5-year, 7-year, 10-year, 20-year, 30-year. And so this is at any given point in time giving you the yield on these various instruments at that same point in time. So as of March 13th, the short-term 3-month treasury is yielding, 4.8% or whatever, 4.7. I don't know what that number is right now, but it's pretty close. It's above 4.65. And then as you come across, you can see all these are lower. This is what's referred to as an inverted yield curve. So here, and you can look at the 2-year relative to the 10-year. You can see that the 10-year is lower. Normally, what we normally see is a yield curve that's going up from left to right. Normally, the longer term treasury yields are much higher than the short term. That's the normal configuration. So this really gets a lot of folks worried when we start seeing an inverted yield curve, because in the short term, that can ultimately have an impact on how financials perform, especially banks and maybe life insurance companies as well. So that's kind of an important thing, and I'll show you exactly what I mean by that in just a second here. Let's go back to 2001 or 2002. So you see this red line right here? That's just where I'm starting in terms of time. And look at the yield curve. This is typical of what we see. And as I go through time, I want you to just see as we move up in 2003, 2004, 2005, there's 2003, and you can see pretty steep yield curve. And then watch as it starts to flatten. See, as the short-term yields are moving higher and the long-term are staying the same or maybe even coming down a little bit. And then we get to 2006, the beginning of 2006, and we start, that's what they call a flat yield curve or flattening. So as we move up, you can see it's flattening. And then it's pretty much flat, right? Well, as we keep going up, you can see it actually turns. And the short-term maturity is actually has the highest interest rate. So we have an inverted yield curve. And then, of course, 2007 to 2009, we had the Great Recession. And so there's history that suggests that when you get an inverted yield curve, you can have an issue with a recession and perhaps the market falling. And that's what's getting a lot of folks upset right now, because as you see, when we went through, after we came through the financial crisis, yields, the short-term yields remain near zero. Remember, the Fed funds rate stayed near zero for a long time. And so that kept short-term maturities down while the longer-term maturities were much higher. And so you can kind of see as we go through 2013, 2014, still very steep yield curve, 2015, 2016. But the Fed started raising in 2017. And look at what the yield curve started to do in 2017. See how over here on the left side, we're starting to rise? It's getting a little steeper, or excuse me, a little flatter and flatter as we go across. Now we're into 2018. We head into the trade war. And when we get into the trade war, didn't quite invert, but we got pretty close. And then we went through 2019. 2019, look at that yield over here starting to move up. It's above both the 3 months above the 2-year and the 5-year, and about even with the 7-year, slightly below the 10-year. That was back in 2019. And then we go up. And then, of course, the pandemic hits and the Fed drops interest rates back to zero. And you can see that's, again, we've got a steepening yield curve. 2020, look at it getting bigger and bigger there. 2021, this is usually pretty healthy for the market. But then we hit 2022. There was no inverted yield curve. Don't think that the market has to have an inverted yield curve to go down. 2022, there were a lot of issues not relating to the yield curve that took the stock market down. Then as we continue dropping, now we've gotten to the point where we're into more of a flattening yield curve by the time we were into the second half of 2022. And now look at where we are. And so this is what has a lot of folks upset. And for good reason. I can tell you this is not good for banks. I audited banks. This is not good for banks. Before I get into looking at the financials, I wanted to pull this up a different way. So here's the yield curve on this tool, but you can also do the yield curve just by picking 2 treasury yields and plotting them. This is a 20-year chart. This is the 10-year treasury yield minus the 1 month. And you can see it up and down, up and down, up and down. And then down here, you can see how the 10-year, when the 10-year, this is a correlation down here on the bottom. So what I did is I took the 10-year minus the 1 month treasury yield and just looked at when it's going down or up, how does it correlate to the performance of financials relative to the S&P 500? And I think you can look across here and say, at least for the last 13 years, it's pretty positive. So the yield curve, in my opinion, is much, much more positively directed or positively correlated with the performance of financials relative to the S&P, not always the S&P 500 itself. If I take out the XLF here and just look at it correlating to the S&P 500, you don't get quite the same picture. I would say there's a slight positive correlation, but there's a lot more inverse correlation taking place. In other words, the S&P doesn't always go with the direction of this particular yield curve or spread. I also looked at the 10-year versus the 2-year. Did the same thing. Here's the 10-year versus the 2-year with the correlation down below, the financials versus the S&P 500. Positive, maybe not quite as positive as the 10-year minus the 1 month, which I personally think is a much better indicator. If I'm wondering how financials are going to perform, I think the 10-year minus the 1 month is the much better analysis. But anyway, here's the 10-year minus the 2-year treasury yield, which a lot of folks like to look at. And you can see there is positive correlation, maybe not quite as much as we saw with the 10-year minus the 1 year, or 1 month, I mean, but still pretty good positive correlation. But what happens if I take out the XLF? So in other words, it's a pretty good indication of what's going to happen to financials relative to the S&P. But now look what happens. If I'm looking at this signal to help me determine where the S&P 500 is going, you might as well flip a coin. I mean, it's sometimes going with the S&P 500. Sometimes it's going against it. I mean, we've had a pretty steep drop in the yield curve for 2 years. And for much of that, we've seen, the correlation both in positive and negative territory. We were very, very negative, very inverse in 2021. So the spread was coming down. Stock market did great. 2022, the spread kept coming down and the stock market went down with it. We saw the positive correlation. Then the yields kept going down, but the market rallied. So I look at the yield curve, but knowing what I know about financials, I think it has much more of an impact on the banks and the financials. And then the question is, how bad is the impact on the banks? If it is really bad, then yes, I do think we could move into a recession at some point down the road. But how much of it's already priced in the stock market? We were down 28% on the S&P 500. We went down close to 40% on the NASDAQ in 2022. We're not far from those lows. How much of it's built in? Something to think about. Anyhow, let's move on. Actually, let's look at this XLF versus S&P 500 chart, because here is the XLF S&P 500. I mean, if we want to see the correlation between the XLF versus the S&P 500 and what the S&P 500 does, right? We just looked at the yield curve and what that does to the XLF versus the S&P. Let's take it a step further. Let's see when the XLF is underperforming or outperforming the S&P 500, what's the correlation to the S&P 500 itself? Look at this chart. I'm going to say it's kind of 50-50, maybe 53-47, slight positive correlation maybe. We spend a little bit more time above 0.75 here. To the downside, we kind of bottom at 0.75. We don't go below it. So I'll say that there's maybe a little bit of positive correlation, but it is not a slam dunk. And so for a lot of folks who think the yield curve, which typically does affect financials, that doesn't always mean the S&P 500 goes down. There's not always that positive correlation. Just food for thought, because you're seeing a lot of talk now about inverted yield curves, banking crisis, and how that's going to be bad for stocks. I just want to point out the history. That is not the case historically. It's like a 50-50 flip of the coin. Let's move on. All right, so seasonality, March seasonality. First thing I want to just show you is over the last month, and one of the things I talked about was when you get to the second half of each calendar quarter, it doesn't do as well. And we tend to see more rotation to defensive areas. So January to February 15th tends to do really well. February 15th to March 31st, not so much. Well, here we are. It's March 14th. If we go back 1 month, which basically takes us to mid-February, look at the two leaders, consumer staples and utilities. I want to show you utilities because I pointed out to members at the beginning of March that utilities love the month of March. Here's the last 5 years, utilities relative to the S&P 500. It's gone up every year for the last 5 years, and it's averaged outperforming by 4.0%. That's a huge outperformance by utilities. And if we go back 20 years, March, 75% of Marches have outperformed, the utilities have outperformed the S&P 500. And the average outperformance is 1.3%, which is higher than any month during the year. So when you go back and you look at what's going on with utilities, don't be surprised. This happens almost every year, right? Look at the relative strength, XLU versus the S&P 500. There it is. Big move up. Right at March 1st. It was like, and I want to show you something else. We'll go back a year and 3 months because I want to show you what happened last year. Here was February. Look at the beginning of March. I mean, it was like all of a sudden, the, faucet is turned on to hot for utilities. Look at it again. I mean, this is not unusual. You need to be aware of what happens historically. All right, moving on. Earnings spotlight. Not a whole lot here. I just want to mention GitLab. They actually beat. They lost 3 cents. They were expected to lose 15 cents, but their guidance was not good. Stock getting hit really hard. Let me give you the latest here. Down 30% right now. 30% based on its slowing growth prospects. Another company that reported, I wasn't seeing any reaction earlier. Slight move down in Caleres. I think this is a clothing stock, I believe. It's either clothing and accessories, or maybe it's apparel retailer. I don't know. I don't remember. But anyway, this one, not really. They did beat, by the way, on their bottom line, 65 cents versus 64. And they missed on their revenues. They came up a couple million short, 696 million versus 698 million. But the stock's mostly unchanged. Lennar reports after the bell today. All right, finally, let's get into the three you must see. So the three banks that everybody's been talking about, I want to show you why this would never be in, should never have been in anyone's portfolio, to be honest. I mean, I want to show you just relative strength of these three stocks. SI, stocks going down. Look at it relative to the banks. Even before this fiasco, it was at a 52-week relative low to the banks. Should have never been in a portfolio. We talk about leading stocks in leading industry groups, not stocks like SI. How about SIVB? They were starting to show a little bit of relative strength after a massive decline in relative weakness. They came up a little bit. We shouldn't be too surprised when there's a big, when the next shoe drops. The last one, SBNY, Signature Bank. I mean, you look at the price action going down. Look at the relative strength or weakness in this stock before they were shut down. Folks are saying, well, how do you know this stuff? Well, you know it because technicals are telling you. There's a reason why Wall Street is not getting into these stocks and why they're lagging. Now, it doesn't mean that they're going to go out of business, potentially. But what it does mean is that Wall Street doesn't believe that this is worthy of their money. If it's not worthy of theirs, it shouldn't be worthy of yours. Anyhow, join me later today. Love to have you for our Max Payne event later today, 4:30 Eastern. Start your no-cost trial by clicking on the button here at earningsbeats.com. Have a great day, everybody. Happy trading.
Hey, Grayson Rose here with StockCharts. Thank you so much for watching. I hope you enjoyed that video. If you did, consider giving it a like down below, maybe leave us a comment, and if you're new to the channel, you can subscribe at the link up above. We're going to bring you daily content from an incredible collection of technical analysts and financial experts.